Imagine you wake up on a Thursday morning, check your portfolio, and see the price of a barrel of oil flying. It's not a small jump of $2 or $3. We're talking about the biggest intraday jump in more than 3 years. What happened? Israel launched heavy strikes inside Iran, targeting nuclear and military facilities. And this wasn't just a neighborly feud. It was the kind of move that puts Wall Street's biggest players on high alert. Why? Because oil isn't just gasoline in your car. It's the blood that runs through the veins of the global economy. When he goes up fast, like now, he becomes a real market mover. And for those who invest in energy or follow dividends from companies like Chevron, ExxonMobil, or even ETFs like XLE, this turns on a light volatility ahead, but also opportunity. In summary, what happened in the Middle East? It's not just an international crisis. It's a trigger that can affect your portfolio here in the US. If you own stocks in sectors that are sensitive to oil or depend on transportation, logistics, or industrial production, now is the time to pay attention. In the immediate aftermath of Israel's attacks, Iran responded in the way only great powers do, with missiles. And these were not symbolic missiles or missiles to get the message across. Some hit Tel Aviv directly. Now get this. This is a game changer. This is no longer just a fight in the Middle East's backyard. This type of action shows that we are entering a level of conflict that analysts call full-scale war, total war. And when a war of this magnitude begins, especially between two such strategic countries, the market feels it, and strongly. Why should you, the investor, care about this? Why wars like this? They shake up the fundamentals that support companies, supply chains, commodities, and, of course, the dividends you expect to drip in every quarter. When missiles start flying, it's a sign that the rules of the game are about to change, and the smart investor starts to ask himself, where are the protective assets? Who profits from chaos? And who will cut dividends when margins tighten? In short, Iran striking back is like someone shouting, "This is serious," in the middle of a trading session. The party is over. Now it's time for the cool-headed to think about positioning, not panic. So let's recap. Israel attacks, Iran retaliates, and the world realizes that this isn't just a regional conflict. It's a multifaceted event, global potential. And now comes the point that most chills the market. The threat to oil supplies. Why? Because this region of the world, yes, the one that always seems to be in the headlines, is responsible for around 40% of the oil that supplies the planet. 40%. It's like almost half the tap is in a place where two powers have just started exchanging missiles. And that's not all. Both Israel and Iran have military capability to target oil installations and transport tanks. They can literally blow up part of the system that keeps the oil flowing. For those who invest, this is what we call supply-side shock. When the supply of something as essential as oil is threatened, the price rises, sometimes brutally, and energy sector companies soar, while energy-dependent companies feel the pinch. So if you have shares in airlines, transportation, or even retail that depends on heavy logistics, this conflict has everything to do with your quarterly results and your dividends. Have you ever thought about how a blockade there could directly affect the shipping costs of Amazon or UPS, or the cost of inputs for agricultural production? That's why, when smoke rises in the Middle East, the smell of gasoline reaches all the way to Wall Street. Here is the data that every investor needs to record. 20% of all the world's oil passes through a single point, the Strait of Hormuz. This is a narrow sea corridor between Iran and Oman, and it is absolutely essential for the flow of oil from Saudi Arabia, Kuwait, the United Arab Emirates, and other Gulf exporting countries. If this strait is blocked, even temporarily, the global impact will be immediate and severe. The price of oil would skyrocket, ships would be diverted or grounded, and the entire global energy supply chain would go into emergency mode. From an investment point of view, energy stocks, COMO, XOM, CVX, OXY, tend to benefit from rising oil prices, oil spike, becoming short and medium-term opportunities for those seeking appreciation, and more. Robust dividends. Airlines, DAL, AAL, transportation and consumer, WMT, AMZN, would be penalized by higher operating costs, affecting margins and dividend distribution. ETFs like XLE and VDE can see greater volume and appreciation, being considered natural hedges in periods of geopolitical tension in the Middle East. Furthermore, a blockade of the Strait of Hormuz would almost certainly attract direct U.S. military involvement, which adds high geopolitical risk to markets and requires caution from investors exposed to emerging markets and cyclical sectors. Conclusion: when the Strait of Hormuz comes on the radar, it's not just a regional crisis, it's a systemic factor that has a direct impact on the S&P 500 and the U.S. economy. Given the real risk of a blockade in the Strait of Hormuz, the next logical step is to ask, how much could this affect the price of oil? The answer is clear: very. Today, oil is around $70 a barrel. But according to himself, U.S. Department of Energy, if the strait is closed, the price may jump to $200 a barrel. This represents an increase of more than 150%. A real oil shock that we have not seen since the worst moments of previous energy crises. What does this scenario mean for the American investor? Energy sector companies can explode in value, not just because of the better margins, but also because many of them distribute fat and constant dividends that accompany the profit. ETFs like XLE, XOP and VDE gain strength as defensive plays, as they directly surf this increase in the price of the commodity. Utilities, transportation, and consumption can suffer. Production costs rise, margins fall, and companies become more likely to cut dividends or suspend guidance. Inflation is accelerating again, which could make the Fed keep interest rates higher for longer. Terrible for sectors such as real estate, regional banks, and cyclical consumption. Additionally, alternative commodities such as natural gas and coal also tend to rise, affecting portfolios that rely on cheap energy to operate efficiently. This possible $200 a barrel scenario is more than speculation. It's a real risk scenario that institutional funds and hedge funds are already modeling in their defensive strategies. This is where things get serious. If you look at the last 50 years, you will see a crystal clear pattern. Every time the price of oil rises aggressively, the U.S. economy goes into recession. It's no coincidence. It's a correlation strong enough to make any investor stop and take notice. Here are some historical examples that work almost like case studies. Oil crisis of 1973 and 1979. Big jumps in prices. Inflation explodes. Fed raises interest rates. Severe recession. Twin recessions of the 1980s, once again caused by oil supply shocks. 2008? Yes, part of the push towards financial collapse was oil surpassing $140 a barrel. In 2022, a recession was only avoided by specific measures and unique circumstances, but the risk was real, and oil was, again, one of the drivers. So why does this matter now? Because if the barrel is $150 or $200, as we saw in the previous topic, you can expect inflation is accelerating again. The Fed is pressured to keep interest rates high or raise them further. Internal consumption is stalling. Less purchasing power, more debt, fewer dividends being paid. Companies with compressed margins and a drop in profits, which directly impacts dividend payout and share value. In other words, what appears to be just a conflict far from the U.S. can, in practice, become a direct trigger for a new American recession. And recession, as you well know, knocks down risky assets. But it also opens up buying windows for those with cash and a long-term vision. Topic 7. How rising oil prices tighten consumer pockets and scare the Fed. When the price of oil soars, it doesn't just affect the price of gasoline at the pump. The impact is much broader and more direct on everyone's lives, including your pocketbook and your portfolio. Here's what happens in practice. Inflation rises. More expensive energy means it costs more to transport products, operate factories, and keep services running. This ends up raising the price of everything from food to electronics. Fed reacts. To contain inflation, the Federal Reserve typically raises interest rates, making loans and financing more expensive. This slows the economy to prevent overheating, but also tightens credit for businesses and consumers. Consumer feels the pinch. With higher gas, energy, and interest rates, American consumers have less money to spend on other things, fewer purchases, fewer trips, fewer leisure activities. This reduces sales growth and corporate profits. Companies feel it on the margins. Higher costs, plus lower sales, compressed margins. This can lead to layoffs and expense cuts, including dividend reductions. For investors, this means interest-sensitive sectors, such as real estate, consumer discretionary, and banks, could suffer, while energy and commodities could appreciate. In short, an oil shock is a domino effect that goes straight through the Fed, the consumer, and the markets, directly influencing your investment decisions and the health of the dividends in your portfolio. In recent years, the US has been dealing with a series of international challenges, but the current moment marks something different, a situation of war or simultaneous military tension on three strategic fronts: Russia, China, and now Iran. Russia and Ukraine. Since 2022, the armed conflict between Russia and Ukraine has been one of the biggest geopolitical crises in recent times, directly impacting energy, metals, and food markets and generating global volatility. The West, led by the US, has imposed heavy sanctions, which brings economic challenges and puts pressure on supply chains. China and the Pacific. The dispute between the United States and China involves trade, technology, and military issues, mainly in the South China Sea, and Taiwan. Trade tensions and the risk of conflict increase uncertainty about global trade and investment flows. Iran and the Middle East. Now the escalation between Iran and Israel, with the potential to drag the US into direct conflict, adds a third front. And this one is especially worrying for its immediate impact on energy markets, given Iran's strategic location and potential control of the Strait of Hormuz. Why does this matter to you, the investor? Volatility and systemic risk. With three major conflict fronts, the risk of simultaneous shocks to commodities, supply chains, and financial security increases significantly. This means that markets can react with sharp and rapid declines, requiring hedging strategies and portfolio protection. Pressure on commodity prices, energy, industrial and agricultural metals are directly affected. Sectors such as mining, oil, gas, and defense tend to see increased demand and appreciation, while sectors that consume these inputs may suffer. Globalized supply chains under pressure. Companies that rely on international suppliers face greater risks of disruption, delays, and increased costs, impacting margins and profits. Military spending and federal budget. With multiple conflicts, the US is expected to increase military and defense spending, putting pressure on the government budget and potentially affecting fiscal policies, including taxes and infrastructure investments. Opportunities and threats for your portfolio. Opportunities. Defensive sectors and commodities could benefit. Threats. Cyclical, discretionary consumption and emerging sectors become more vulnerable. In short, this war on three fronts redefines global risk and demands from the American investor an active, diversified management prepared for greater volatility, with a focus on protection and identification of opportunities for sustainable growth. Topic 9. The US role, entering the war or avoiding direct conflict. So far, the biggest unknown in the market is the stance that the United States will take in the face of the escalation between Israel and Iran. There are basically two main scenarios. the US does not directly enter the conflict. In this case, Iran would likely avoid extreme actions such as blocking the Strait of Hormuz so as not to provoke direct American military intervention. The conflict could remain regional and contained, limiting global impacts, and oil prices could stabilize without major shocks. For investors, this would mean lower volatility and a potential quick market recovery. The US enters the conflict directly. Here, the most worrying scenario unfolds. Iran could retaliate by blocking the Strait of Hormuz, cutting off 20% of global oil supplies. This would bring a brutal energy shock, with soaring prices, accelerated inflation, and a potential collapse in financial markets. The Fed would likely have to tighten monetary policy further, raising interest rates, which could push the economy into recession. What does this mean for investors? In the event of no direct intervention, investors can maintain more aggressive positions, taking advantage of opportunities in the American market. If the US enters the war, the strategy should be more defensive, with increased exposure to assets such as energy, gold, and quality bonds, in addition to reducing risk in cyclical sectors. Ultimately, the market is looking to Washington for clear signals. Any move from the US will be an immediate trigger for moves in stocks, commodities, and currencies. Faced with this complex scenario, the watchword for investors is protection and diversification. Here are the strategies that make sense now. Increase exposure to energy sectors. With the real possibility of an oil shock, companies like ExxonMobil, XOM, Chevron, CVX, and ETFs like XLE should be watched closely. They tend to pay solid dividends and grow during high oil prices. Consider gold and precious metals. They are classic hedge against inflation and geopolitical uncertainty. Funds like GLD and SLV can help balance your portfolio, reduce exposure to interest and consumption-sensitive sectors. Real estate agencies, regional banks and retailers may suffer from higher interest rates and lower consumption. Consider reducing your weight in these areas. Diversify with quality stocks. US Treasury bonds, especially medium and long-term ones, can act as a safe haven in times of turbulence. Maintain liquidity and avoid sudden movements. In times of high volatility, making big changes can be risky. Dollar-cost averaging remains a good practice for long-term investors. Pay attention to market signals. An oil price closing above $76, for example, could be a trigger to adjust risk exposure. With these strategies, you will be better prepared to navigate the waves of this conflict and protect your assets, while taking advantage of opportunities in sectors that may appreciate in value. Historically, when the price of oil rises too quickly, especially more than 30% in a short period of time, it has been a red flag for the American economy. Here's why. Higher cost for businesses and consumers. Oil is the backbone of our economy, from gasoline for transportation to the production of plastics and other goods. When the price goes up, it increases the cost of just about everything. That reduces companies' margins and consumers' money to spend on other things. Inflation soaring. Higher costs have a direct impact on inflation, which is already a major concern. With high inflation, the Federal Reserve feels pressured to raise interest rates to try to control prices. Higher interest rates slow down the economy. Higher rates make it more expensive for businesses to invest and for consumers to take out credit, reducing consumption and growth. Recession on the way. Almost every U.S. recession since the 1970s have been preceded by such energy shocks. The domino effect leads to spending cuts, rising unemployment and falling corporate revenues, all of which push the country into recession. For investors, this means that gains in stock markets may be limited or even negative, and that energy-related sectors can perform better than the rest. We are facing a moment of high tension that could be a turning point for the economy and global markets. The conflict between Israel and Iran, combined with the war on three fronts involving the US, Russia, and China, greatly increases the risks of an energy shock and an American recession. What is clear to the American investor, the price of oil is the main thermometer. If it soars to around $200 per barrel, the impact will be profound on inflation, interest rates, and consumption. The energy and defense sectors are likely to benefit, offering good dividends and protection against volatility. Sectors sensitive to interest rates and consumption should be treated with caution, as they may suffer from an economic slowdown. Diversification, use of defensive assets, gold, treasury bonds, and maintaining liquidity are essential to weather the storm. It is essential to closely monitor U.S. decisions and market signals to adjust your portfolio as the scenario evolves. In the end, the investor who knows how to navigate with discipline, patience, and strategy will come out stronger, protecting dividends and taking advantage of growth opportunities in resilient sectors. We are living in a decisive moment that could redefine the global economy and directly impact your pocketbook. The escalation of the conflict between Israel and Iran, combined with the geopolitical challenges on the fronts of Russia and China, poses real risks of a shock to the oil market, an essential fuel for the global economy. For you, as an investor in the United States, understanding these risks is essential. A sudden increase in oil prices could trigger inflation, raise interest rates, and slow consumption, creating an environment that could lead to a recession. But it's not all risk. Sectors like energy and defense could appreciate, bringing opportunities for more robust dividends. And hedging your portfolio with assets like gold and treasury bonds is key to weathering this storm safely. Keep an eye on market movements and political decisions, because volatility can bring both challenges and opportunities. The right strategy, based on discipline, diversification, and patience, will make all the difference. Ultimately, you've gone too far to ignore these signs. It's time to act smartly to protect your assets and position yourself for what's next.